Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Rick Bensignor. He's founder of In the Know Trader, which provides retail traders access to institutional models. Rick is also an expert in applied behavioral finance theory. And Rick, it's great to have you on Trade Talks. It could not be a better time to have an expert such as yourself on, because we know not acting on emotion is paramount in the investing world. Give us some background on what applied behavioral finance is.
So the school of behavioral finance theory is certainly an academic one. What I've been able to do is apply many of the foundations of behavioral finance theory, and I was the first to teach it at NYU. They had come to me to develop their entire behavioral finance program. What I've been able to do over the years is take the foundations of behavioral finance theory and specifically apply them to certain ways of being able to trade in the market, such that we can take advantage of the mishaps and the often poorly timed trades that portfolio managers do to take advantage of essentially their mistakes at the perfect time for us to act and the very worst time for them to have made the decision that they did.
So it sounds like a lot of psychology / financial planning / investing / trading all goes into it. For retail investors, how would that be applied this week? There's so much going on in terms of what's happening in the market, what's happening in the economy, what's happening with the Fed.
It's really a matter of getting a handle, often before the news comes out, of what's showing up underneath the seams. So for instance, we had been long financials versus the S&P for a long time. December 1st, I swapped out financials because there was implied weakness showing up, nothing to the tune of what has now occurred as far as the demise of the S&P financial index relative to the S&P, but there were undertones of difficulty in financials. So we swapped out of financials and actually went into XLC, which is communication services. So we were able to capture a huge move up in Meta and some of the other names that lead that sector, and took financials off. And so it took a few months for it to show up definitively, but you start getting whiffs of this often before it actually occurs. And that's where we feel we have a significant edge over most people who play this game, because we use a multitude of approaches, including fundamentals, quantitative, behavioral, technical analysis, market timing, and behavioral finance. And we would combine all these together. You still have to have an edge in how you look at any one of those subjects, because if you look at fundamentals the same way somebody who, let's say, has a CFA and was taught in college how to value a company, you essentially have no edge over everyone else who plays that same game. You've got to have something that's distinctly different. In each one of those categories, we have an edge compared to the rest of the street because we approach markets in a very different way than most people do, to give us the ability to continuously outperform the S&P year after year. In fact, I can tell you there's only one time in the last 7 years I have not outperformed the S&P. And if you know anything about the money management industry, which I suspect you do, Jill, you will know that there are very few people who over time can consistently beat the S&P. And we do because of the process that we have. And we are very process driven. It's not black box, but there's a whole foundation to how we choose what we do and when we do.
So it sounds as if not only are you very process focused, but you allow the models to evolve over time. Because to your point before, if you only focus on the fundamentals, even in this market now, think about it, since 2020, there is no trader that I'm aware of in the past 100 years that has traded through a pandemic that was able to see what it looks like on the other side. Let's add in a war, happening in Europe, and then how fast rates have raised. It's something, you can't just use what you learned getting, an accreditation. To your point, you have to allow these processes to evolve with what the market is giving you too.
Yeah, so there's certainly short-term traders who try to play every little nook and cranny move in the market. There are the long-term traders who actually right now I've done a couple of webinars today, plus a radio interview. And what I was making a point of it, if you look at the mega bulls this year, Jill, and they're certainly very obvious who they are on the street, they're constantly on TV talking the same story. You look at the mega bears and those who are calling for the S&P to go to 3,000. Neither have been proven correct so far in the first 3 months. The people who've actually been able to play this game and so far outperform are those who have been able to identify the, let's call them the seesaw that's gone on inside the market so far this year. And I will continue with, we are in a trading range unless we see to the upside, Friday closes above 41.48 in the S&P, or Friday closes beneath 38.62. And last week's close was 38.62. So as long as we're within that context, all the people telling us which way we're going to go is just noise. Everything else inside is more for traders, and traders have had the better year so far. Bulls haven't won and the bears haven't won. The traders have won. If we break either of those two limits on the upside, 41.48, 38.62 on the downside, then you probably have a more pronounced move in that direction. If I had to pick which one it was going to be, it's probably to the downside. But I'm willing to play levels as long as they hold. And if you think about how much selling was seen earlier this week, and the S&P broke those levels intra-week, but the market absorbed that and got up to what, 39.50, 39.60 yesterday, something like that. It shows you those who are playing for the big move are constantly on the wrong side of the trade, and then they scamper to get out. They sold weakness, they buy strength. And right now, the smartest thing to do is to sell strength and buy weakness, which is really what we're all taught to do in the first place, buy low and sell high.
Yeah, well, I mean, everyone buys low and sells high on Twitter. That always seems to work out, doesn't it?
Yeah,
Right.
isn't it? It's kind of amazing how everybody
Short at the
advertises
top,
that
buy
they
at the
do
bottom.
it.
It always seems to work out on your Twitter feed. Rick, we
Correct.
appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.
Oh.